Howdy, hot shots. Dividend Daddy here, your favorite not a financial advisor with not financial advice. Whew, I am out here working like a dog, working like a regular dog in this Texas heat. Got the sun beating down. It's like 100 foot from water and 6 foot from hell, boy, I'll tell you what. But I wanted to talk to you. We see people talking about NAV erosion in ULTY, okay? It's not really NAV erosion. They think that just because the distributions are coded as ROC or return of capital, that what they're really doing is giving you back your capital. Well, you know, in the eyes of the tax man, not that I'm an accountant, but in the eyes of the tax man, that's the way I understand it initially until you run out. So let me ask you a question. When your return of capital gets to zero, you think the fund just stops? No. So they are making income every day, every week, every month. They are making income from selling covered calls and puts and credit spreads. And that's how they're getting the money for your distribution. Now, do they pay out 10 cents even if they didn't make 10 cents that week? I don't know. I'm not running the fund. Do they pay out 10 cents even if the fund dropped in value because the underlying's dropped? Maybe they're paying out all the income as far as I know. So if they're making 10 cents and paying out 10 cents, but the underlyings go down in value, well, your fund goes down in value. Anybody that owns a stock understands that stocks can go down in value. The risk for ULTY, the major risk that I see, and I'm not saying that it's necessarily guaranteed. I'm not saying that it is a nail in the coffin for ULTY or ULTY holders. But the risk is, and anybody who's traded options in the past understands this, and I recognize that a lot of people who have these funds have not traded options. If you sell covered calls, then the amount that your capital can go up is limited. Your gains are limited. Your losses are only limited by the cost of the stock. So it could go to zero. So if you have a $20 stock and you sell a covered call for $22 and you gather a $1 premium on that, then your upside is limited to $3. Okay, now you can roll the call out, and I'm sure these are sophisticated investors that are running this fund. They probably do some loss mitigation type things. They roll it out, they roll it up. I'm sure that they look at that and try to maximize their return. So you can mitigate some losses in gains that way. If you sell a put and your put's going to get assigned, instead of getting it assigned, you could roll it out if there's a credit available for that and make a little bit more money before the stock gets assigned to you, or give it a time for it to go back up. But your gains are limited. Your losses are only limited by the price of the stock. So you could go down on that $20 stock. It could go down $20. So your loss would be $20 minus the dollar that you collected in premium on the covered call. $19 would be your loss. So your gains are capped at $3, but your losses could be $19. That is the major drawback to covered calls. And it's the major drawback to a covered call fund. In a down market, it will go down quickly. Now, we went over the holdings the other day, and we saw that they did have some puts. Do they have enough puts to guarantee that it won't go below $6? No. They have some stuff in there to salvage the fund. You know, they have puts in there. They can't spend all the money they're making on the covered calls buying puts. That would negate the purpose of the fund of generating a distribution, generating income. So that's not what they're trying to do. Those puts are there in case of catastrophic failure. It's like insurance, okay? Not the best insurance, but insurance. You know, insurance that if you stub your toe, you're not going to the emergency room because it would be too expensive. But if you need a heart transplant, you get it, okay? That to me is the type of puts that they're buying. They're in case of catastrophic failure of the market or of the basket of stocks that they're holding. But that means that when the market goes down quickly, ULTY will go down quickly too. And then it is a tooth and nail fight, dragging itself back up. Okay, that's the drawback. Now you're getting such a huge distribution that hopefully before that happens, you're in the green. And after it happens, you've picked up more shares on the cheap so that as it crawls back up, you are making even more distributions. If it were going to pay 10 cents a share forever, regardless of what the price did, I would put all of my money in it. Right now, 100%, I would put all my money in it because that's a huge return for the rest of your life. If I could buy an annuity that paid me 80% for the rest of my life, but my principal was all gone, I would do it with every dollar I had, okay? That's what some people think of ULTY, is that it's just going to continue to pay. And I, using hyperbole and exaggeratorily said, if it went to a penny, but it was still paying 10 cents, I would keep it. That's true. That's 100% true. Do I think it could go to a penny and still pay 10 cents? No, not a chance in the world. They use the stocks that it holds to generate the income. If the stocks that it holds are only worth $1 in total, so the fund is $1 for the share price, you can't generate 10 cents a week off of that. They're not making 10% returns every week. We know that, otherwise they'd be paying out 10% a week and our yield would be 520%. So the fear is that the price goes down and then it doesn't continue to pay the distribution that it's paying right now. I understand that fear. It's a real fear and it is, realistic. And if we get into some bad market times or they make some bad decisions, it's a probability that will happen. Now, will the fund come back after that? Well, it came back after April, so I would hope that it would. They've got more protection in place now, as I understand it. I saw the puts in their holdings, so hopefully that would help them a bit. Would they suspend distributions while they were rebuilding the fund? Ooh, I don't know. That seems like the death knell. Would they reverse split if it got too low? I think they'd have to. Would you prefer, just write down in the comments and let me know, would you prefer that they suspended distributions for a while, or would you prefer that they did a reverse split? Personally, I'd rather them suspend distributions for a while than do a reverse split, because a reverse split is just terrible in the market. Not that suspending distributions isn't, but at least it would build it back up without having that reverse split on the record. Because everybody knows reverse splits are just a no-no. Okay, and we understand why it happens. It's like the VIX, how the VIX just keeps eroding, and eventually it does a reverse split. So I don't want it to continue to erode in value because of that. The distributions will get smaller, and then you won't ever be able to dig your way back out unless the fund recovers some too, which hopefully it would. I would rather them even give me a lower distribution and sell calls a little bit further out so that they get some gains to sustain the fund. And maybe that's what they're doing. We're still learning about ULTY. We're still experiencing this new type of fund, really. This high of a yield is not something that has been common practice. That type of yield was only available to the richie riches, people out of my league, people above my economic class, let's say. I'm not going to say they have more class than me, but they're above my economic class, 1%ers and such. I'm probably just a measly 4%er or something. I ain't one of them 1%ers. So we don't want to see it continue to go down in value, but that is the risk. The risk is that it goes down faster than it goes up. And so once it goes down, it takes a while for it to come up. Now, if you've stuck around this long to hear my ramblings, the one thing that we have on our side is it seems like it's inflation infinity now. It seems like rather than let us go into any kind of deflationary period, rather than let the market falter, rather than let the housing market falter, which all of these things actually need to be adjusted. And it wouldn't even hurt my feelings if I lost half my money that I have in the stock market, because I would just keep piling more in and it would come back eventually and I'd get some on the, at a reasonable price. Because right now, nothing is reasonably priced. Houses, stocks, bonds, nothing is reasonably priced. Everything is too high because there's too much money floating around, because the government likes to take it all and print it to oblivion and give it to all their cronies. Okay. And then they go out and buy all these assets and deprive us of them. And so, no, I don't really want these bubbles to exist, but they do. And it seems like it's going to for the foreseeable future. Now, anything could be the straw that broke the camel's back. I mean, these tariffs that are going to be implemented next week, those could be the straw that broke the camel's back. It almost seemed like they were going to back in March or April. Unemployment numbers could come out and they actually tell you the truth of what they are. And that could be the straw that broke the camel's back. Chinese real estate could collapse. Canadian real estate seems like it's collapsing. All of these things are tied to all the major banks. There could be bank failures, but they proved to us last time that they're not willing to let the banks fail the way that they should. They've proven over the last 5 decades that they won't let businesses that should go under go under. So at this point, it seems to me like they think every single little tiny thing is just too big to fail. And if they're just going to keep printing money to oblivion, not that the returns would be that great compared to inflation, but they might all still be nominally positive. All right? So anyway, I'll talk to you degens later. I hope you have a great weekend, and I hope you're making a lot of money.